Good morning and welcome to this Monday, August 8th, 2022 edition of Trading Places Live at EarningsBeats.com. I'm Tom Bowley, Chief Market Strategist here at EarningsBeats, and I'll be your host for the next 30 minutes, featuring everything you need to know as you prepare for the trading day ahead. Well, we're going to start off another week. Last week was a little choppy. We did move higher on the major indices, so that's always a good thing. But definitely things started to slow a little bit from where we had been. But currently this morning, at least at last check, got futures looking up pretty good. NAS futures up about 100 points, Dow futures up 160, S&P 25. So looks pretty good. Looks like we're going to get off to a decent start. Crude oil prices down about another $1, sitting at about $88 a barrel. We lost that $93 support level there last week, and we've stayed below that level. That'll again maybe start to lessen some of those inflation headwinds, at least headline number. And we do have a couple big inflation reports coming out this week. I think they're going to be good. I said last month I thought that we were going to have a big shocker to the downside this month, at least on the headline number. We'll see what happens, but I think we're going to get that later this week. 10-year Treasury yield down 4 basis points, back down just below 2.80%. Watching that, obviously, that gives us some clues as to what the bond market is thinking about inflation. We should be seeing those yields soaring if bond market felt that inflation was a problem. And we're just not seeing that. We're seeing more consolidation. We hit that high at 3.48%, fell back to 2.7 or maybe in the 2.6s. And now we've rallied back up, went up to near the 20-day moving average, pulling back again now. So I think we're in more of a sideways consolidation phase there, but that's good news. Anything going sideways is better than going up in terms of the yield. So that's good. We do have a big event later today. It's a free event. We talked a little bit about our what I like to call our draft, where we draft the stocks for each of our portfolios. I got some big changes coming up this year in those portfolios. So, if you want to check that out, you want to be part of that, if you go over to EarningsBeats.com, you'll see right here on our homepage, we've got this top 10 stock pick sneak preview. We're going to talk a little bit about the actual draft, which will occur next Thursday. So normally we do it on the 19th of every third month. We do it February 19th, May 19th, August 19th, and November 19th. This quarter, however, the 19th falls on a Friday. I don't know about you all, but I don't really want to do it on a Friday and don't really want to do it on Sunday night either. So we're going to do it Thursday. We're going to announce on Thursday night the stocks that we will be putting into our portfolios on Friday at the close. So you actually get a day ahead of time to prepare whatever you want to do. We've got a great long-term track record, especially with our two flagship portfolios, which are our model portfolio and aggressive portfolio over the long term. Both of them are basically doubling the S&P 500 since we started them. But anyway, if you'd like to know how we put them together, the changes we're going to make, all of that, we're going to be talking about that after the close later today at 4:30 p.m. Eastern. This is open to anyone who is a subscriber to our free Earnings Beats Digest newsletter. So if you scroll down right here, all you got to do is put your name, email address in, hit subscribe, and you're eligible to come tonight. There's no credit card required. You don't have to, worry about paying anything or giving your credit card. This is our educational newsletter that we provide, try and give back to the community, things that I've learned over the years. We focus on things like earnings, gaps, candlesticks, those trend lines, your basic technical analysis stuff, but then we have our own little twist. So if you want to learn more about how we approach the market, this is probably the best way to do it, along with listening to these shows and following my blogs over at Stock Charts. But the Earnings Beats Digest is published 3 times a week, Mondays, Wednesdays, Fridays. So just had one come out this morning talking about upcoming earnings this week and how one of our chart lists, I'll show you a little bit later in the show, how you can take this chart list and basically, it's almost like Wall Street's giving you a scorecard of what they believe about these companies as we approach their earnings reports. But again, I'll talk about that a little bit. Anyway, go over to EarningsBeats.com, make sure you scroll down and sign up for that EB Digest newsletter, and then come join us at 4:30 today and talk to you a little bit about how we put these portfolios together and some of the changes we're looking at making this quarter. All right, looking back at Friday, August 5th, Dow Jones Industrial Average ended up 76 points. S&P 500 was down 7. NASDAQ was down 63. Mid caps were up 14. Small caps were up 6. So really bifurcated action, some up, some down. Not really too worried about it. I mean, all of them are in an uptrend. All of them have strong AD lines. Everything looks pretty good. And to be quite honest, a pullback wouldn't be horrible. Probably give the bears a little ammo. I'm sure we'd see sentiment turn pretty bearish again rather quickly. It really wouldn't be a bad thing, but I can tell you, and I'm going to go over this in just a bit as well. When you come out of these cyclical bear market bottoms, sometimes they don't, you don't wait. I know there are a lot of folks saying, well, yeah, I'm starting to think maybe that was the bottom. Let me wait until it pulls back, gets back, maybe puts in a double bottom or at least pulls back a little bit. Sometimes these rallies don't stop. And that's the part where if you don't look at the signs and you don't realize when the risk is going against you as a short or even someone in cash, that's when you can kind of get behind the 8 ball. And then it becomes very, very difficult to pull the trigger to get in onto one of these rallies. Because sure enough, as soon as you get in, that's when we're going to have a pullback. That's, just Murphy's Law, right? Looking at the individual sectors, energy up 2% on Friday. Financials up almost 0.75%. Materials up just a bit. That was up about 0.3%. Then we had the XLY. That was down almost 2%, about 1.7%. So that was obviously the worst performing group on Friday, and communication services down 1.25%. So Friday was not a very good day for the market. As you can see, we did have financials, which is one of the aggressive groups, but one of the least effective, I would say, or maybe effective is not the right word, but the one of them that I follow the least, probably is among the 5 aggressive groups, the one I follow the least. Financials, you just want to have going along for the ride. Financials are rarely going to lead the market for an extended period of time. That's just not that group. I mean, when you're talking about banks and life insurance companies, these are the companies that if the economy's strong, they're kind of the engine that keeps things going, especially banks. I follow very, very close attention to the banks because I do feel like it's important for the banks to at least be doing well. And when they're not doing well, that can make it much more difficult for the overall market. But really, when I'm looking at the aggressive sectors, I'm looking at technology, consumer discretionary, and communication services, because I know from history, during secular bull market rallies, those are the 3 groups that we really want to watch, pay attention, not just watch, we want to own during rallies. But they're the ones you want to pay attention to. When they start to lag, you need to take notice. If it's a day or two, no big deal. They're not going to lead every day. But you do want to kind of look at the bigger picture and just see if they're trending higher. If you take the XLY $$ SPX, that gives you the relative strength of discretionary. If you plot that on a daily chart or even on a weekly chart, one thing you can look at is how that relative PPO is doing. On a daily chart, especially coming off the bottom, I want to see that go positive and stay positive. And right now it is. So that would be something I would definitely look at. Anyhow, that's just a recap from Friday. Let's keep moving. So right now we've got a quick update. 10-year Treasury yield, as I mentioned, was down a little bit here. Still down just about 5 basis points, 2.79%. Here's the downtrend. What I was seeing here was potential head and shoulder. So if we annotate this, this is kind of what I was looking at here. So there's your neckline coming across. Here was your left shoulder, left side of the neckline, head, right side of the neckline, right shoulder, breakdown, retest. And now if this 10-year Treasury yield goes down, I don't see the stock market pulling back. I think the only way the stock market pulls back is if we continue to see the 10-year Treasury yield consolidate. If we get the 10-year Treasury yield back up to 3%, That's when I think you see stocks pull back, maybe even a little bit more meaningful, maybe back to the 20-day or maybe even possibly the 50-day, although I would probably be looking more for 20-day test. But if this yield turns back and rolls back over to the downside and inflation is as benign this week as I think it's probably going to be, I don't think the stock market's coming back down much, if anything. As far as economic reports out this week, anytime I look at the 10-year Treasury yield, I generally look at, or at least want to be thinking about, economic reports, because that's really the bond market. How the bond market reacts to certain economic reports is really important to me in my evaluation of stocks. I want to know what the bond market is doing. Bond market's much smarter than the stock market. Stock market gets manipulated all the time, up, down. It's hard to, on an individual daily basis, really difficult to do much with the stock market. It's really about the big picture with stocks. The bond market's a little different. I like to see how the bond market reacts to certain things. Well, it's not going to do much reacting today because there's no economic news out. Tomorrow we have productivity, which is not really going to be that big of a mover. Then Wednesday's when the fireworks could start. CPI. So we're going to get the July CPI report out on Wednesday, and then July PPI comes out on Thursday. Now, last month, 2 months ago when we peaked, the inflation numbers were really hot coming through here. Last month, we got, didn't see nearly as much volatility with the inflation report, but I believe this one's going to be different. And I'll show you the reason I think it's going to be different. Now, this is from what I recall. I went out on Google and I tried to search to try to figure out when they calculate the CPI and the PPI, how, what dates they use. It's not like they just do the calculation as of yesterday's close. They do it and they cut off dates. And I'm pretty sure when they look at crude oil, and this may be more of the PPI than the CPI, but when they look at crude oil, I am almost certain, based on what I remember from years ago, that the cutoff, like for this month's report, it's going to go from the 12th of June to the 12th of July. Now, last month, if you recall, in July, if I'm right, and it goes from the 12th, here's would have been May the 12th down in here, June the 12th, it was pretty strong. And as a result, we ended up getting a higher than expected inflation reading. Well, if I'm right about those dates, I want you to look at where June 12th was and where July 12th was, because we came down from about $123 a barrel down to about $95 a barrel. So that's about a 23% decrease in crude oil prices. How do you think that's going to translate into this inflation, the inflation data coming up this week? I mean, for the last several months, it's been mostly going up. We haven't really had any periods where we've had significant declines in oil prices this year. I mean, if you look from the 12th to the 12th, here's the 12th up to the, I don't know, maybe 12th right in here. Or no, 12th would have been the 11th right there. But that was up. So the 11th, even here, you think, well, it came down. Well, not really, because there's the 11th, which was 110. And then here's the 12th, which was maybe about 102. So yeah, it was down a little bit, but then it was back up the next month, back up the next month. This is the first month where we're going to have a significant decline in crude oil prices, which is going to factor in to the PPI, and probably with gas prices going to factor into the CPI. Headline numbers. Be really interesting to see what the media does with this one, because usually they focus on the headline number and pay no attention to the core. When you strip out that fast rising crude oil and food, and that, the food and energy, which is highly volatile, usually they just focus on the headline number. This month, I have a feeling the headline number is going to have I don't know if it's going to be negative, but I think it's going to be below expectations. And so I wonder if now they'll focus on the core, because that'll get stripped out. Be interesting to see. Because remember, good news, you won't really get a whole lot of clicks when you're posting good news. Crude oil drops, CPI drops. That's going to be like 1/5 the number of clicks if you say Inflation's the highest level in 42 years. So let's see how that comes out. But anyway, that's going to be Wednesday, CPI, Thursday, PPI, initial jobless claims, of course, out on Thursday as well. And then Friday, consumer sentiment. So we really don't have much on the calendar in terms of economic news, but the CPI and the PPI are going to be the big ones, no doubt. Wednesday, Thursday, 8:30, get your popcorn ready. S&P 500. Looking at the S&P 500, I mean, we're going up. I don't know what to say. I mean, you know, I saw signs that said to get in here, and now we're going up. We haven't gone back down here. We had a couple little aftershocks, didn't quite get down to the bottom, and now we're just trending higher. And I keep seeing folks talking about, well, this looks like March. I don't think it looks like March at all. I really don't. I mean, here on the first rally, I can tell you, because I follow it every month, there was a ton of in the money put premium in the market. And so this rally over these 4 days, which made up most of that March rally, probably close to 2/3 of it, that right there, in my opinion, was pure manipulation. Short-term move back to the upside probably saved market makers. They made a bundle here, because if you just understand how it works, I'll get into this next Tuesday when we do Max Payne. I don't want to spend a whole lot of time here, but market makers can make money on the down when the stocks are going down and everybody's buying the puts. They can then turn around and reverse and buy. They cover their shorts, they go long, they start driving prices higher. So they make money on the short side, they make money on the long side, and then they wipe out all the premium, that net put premium, by driving prices higher into option expiration Friday. So I can only imagine that financial firms were having a pretty good party on Friday night that week after the big reversal that we saw. Now, we did go back up one more week, but as we went back up, I mean, the volume on that was going down here. You know, and I don't normally pay too much attention to volume, because you'll normally hear me say volume coming out of bottoms doesn't matter. It's always lighter than it was on the way down. Why? Because there's panic on the way down. There's not panic. I don't know anybody who, when the market's at the very bottom, panics to get in. Everybody's panicking to get out. That's why the volume spikes on the way down. And then once you get down and start moving back up, normally that's when you see the volume start to dissipate. But anyway, when I look at this, I do see the volume lightening, and I'll tell you why I'm saying that in just a second. But here we make this move, go to a new high, we take out these highs, everything looks great, and then back down we go. And so now, you know, here we are back up. How can this be any different? Well, look technically. I always say the first thing, when you're trending higher, one of the keys, one of the most important parts of trending is hitting your moving averages and bouncing and going back to new highs. So we don't know if this is going to be something really good until we go back. We put in a nice hammer on the 20-day. You see that right there on the 20. Now, if we had turned back around and gone back toward all-time highs, I probably would have said that this is a cup. You know, my call for a cyclical bear market, probably not going to happen. Back early January, I said my minimum downside target was 4,300. And we got down in the 4,100s here. So I probably would have been saying, well, that's the end of it. You know, we're just not going all the way back down into the 3,000s. But notice what happened there at that 20-day. Failure. We didn't really even bounce off it. We just hesitated for a couple of days, and then we broke down, went back up, couple of false breakouts at opens to the upside, came back down, closed beneath, and then the rest is history. Back down to new lows. This was a massive sell-off for the market. Anytime you drop from 4,600 down to 3,800, 800 points on the S&P 500. I mean, we're talking about 17% in 7 weeks. Pretty significant decline. Anyway, so this rally, notice we moved up above this double top. This one moved up above this double top, came down, tested the 20-day, came down, tested the 20-day, failed. And on the failure, volume started picking up as we went lower. Here, we had a successful test on the 20. We break out, with increasing volume on the breakout. So anyone who says that move and this move looks identical or look similar, I don't agree. I mean, everybody interprets charts differently, and that's fine. I just wouldn't agree with that assessment. And also, based on what I was seeing down here, tells me to think more bullish thoughts. Back here, I was not thinking bullish thoughts. I'm sure I could go back and pull up articles or daily market reports that I sent to our members back here saying, I don't believe this is it. I believe we are going lower. I'm almost certain that would have been the gist of my discussions back there. I mean, it's nice. This was options related. Yeah, we've gotten a little bit of a rally, but still doesn't look like a bottom. And sure enough, we ended up going back down. Last week's performance. Okay, so when you're looking at the S&P 500, this is that little choppiness. See how we were going straight up prior back here, going straight up. This is just more sideways consolidation. Still trying to get through that 4175 area. On this sideways consolidation, though, if you look at how the sectors performed, it wasn't just churning. This is actually somewhat bullish. Look at the three groups that did the best last week during all that quote unquote churning. Technology saw money rotating toward it. Communication services, consumer discretionary. There's our three top groups. And if I had to pick the fourth group I would watch, it would be industrials. Financials would be the fifth. That's the order. And then healthcare would probably be sixth. And then, of course, the relationship between discretionary and staples, always looking at that. In a secular bull market advance, I'm not worried about any of the defensive groups. I'm really not paying attention to. Utilities, real estate, don't care. Materials and energy are just kind of, I call them neutral sectors. They can go up in bull markets. They can go up in bear markets. They have their own, they just do their own thing. I've never seen really correlation, positive correlation with energy and materials with really anything else, you know, in terms of the other sectors. I mean, I've seen them lead bull markets. That was back in the cyclical bull market from 2003 to 2007. Materials, energy did extremely well back then. That was during a bull market. And then recently, during the cyclical bear market, we've seen energy and specifically materials, maybe to a lesser degree, energy do much, much better. I mean, probably if we go back 6 months, probably still be on the top. Well, right up there with utilities, defensive group. So energy leading during a bear market in 2003 to 2007, it led during a cyclical bull market. Energy does whatever, just does its thing. All right, this is something, I wrote this article about a week ago in my Trading Places blog, and I was looking at it. Well, I wasn't looking at the blog article. I was actually looking at some of the charts that I had in this blog article. So I thought I'd pull this back up because what I was trying to highlight was how we typically come out of cyclical bear markets. And so these are more shorter term type bear markets. And what I noticed is that once you go through the 20-day moving average and you come back down, that first low after going through the moving averages normally marks a key low that we don't go back down beneath. More times than not, almost every time, not quite, but close. So that's what I'm really looking for, is breaking out, pulling back to those moving averages and then breaking out again. To me, that's further confirmation of what I saw back in June. Now, this is the 1957 chart. The other thing I want you to notice on these charts as you go through is look at the RSIs. On the move through, the first move through the moving averages, notice the RSI would get to 60, which is where we generally top out during any rallies during a bear market. But when we pulled back and hit the moving averages, the RSI drops. It stays above 40 as we go forward. You'll look and see that for the most part, we're going to stay above 40. And then when we break out again, we make another trip up to RSI 70. Usually, you don't see RSI 70 during cyclical bear markets. During this one, you don't see it anywhere. But So this is the technical behavior that we're looking for. Break above the moving average, test it, break to a new high. Move up to 60 on the RSI, pull back, break up to 70 on the RSI. That was 57. Here's 61. This was one that violated the, I said that most of them, well, this one did hold the ultimate bottom, never went back and got that second, that double bottom, but that would have been quite the head fake to the downside before moving up. So nothing in the stock market's ever completely easy, unfortunately. But here was the move. We got through the moving averages, tested the moving average, went up here and broke out again. Went up to 60, back down to 50 on the RSI, up to 70. So are you looking, check out that formation. Same thing during the cyclical bear market, the RSI never really even close to 70, not even close to 60. How about 1966? There's your cyclical bear market. Here's your move up through the moving averages. Here's your pullback to test the 20, new highs, off to the races. Here's your move to 60, pullback, only got back to about 55 on the RSI and then to 70. Confirmation. 1968, move through the moving averages, pull back slightly below, and then break out to new highs. There's that low going across. Here's your move up. Here's the move up. RSI got slightly into the 60s, right back down to about 40, maybe just below 40, and then back up to 70. So by the time you were up into here and RSI in the 70s, you should have been thinking, okay, this is over. Would have been confirmation had you called the bottom earlier. 1980, here's the big move. We didn't really have a pullback for quite a while here. Pulled back, made this bottom. And by the way, this was a big move in the month of August and into September in 1980. August, September tend to be weak months. So just want you to see that even in this bear market, we came, cruising out of it during the bearish months of August and September. Pulled back, initial move is there, and then back up to new highs. Here, we got up, we were already to 70 on the RSI. So this one, clearly, I don't even know. I mean, there's a little pause right in here somewhere, but really not much of one. So this one didn't quite set up. 87, here was the break above the moving averages. Here was your pullback, and there was the move up. Here was the 60, back down to about 63, not quite to 70. Here was a little bit of a head fake. Few days, it looks like maybe one or two closes just beneath this close, and then back up again. 1990. This is the one that I've compared this current cyclical bear market to the most, 1990, just because it looks very similar. It had an oil crisis. It was the Persian Gulf War. There was just a lot of similarities. The Fed got hawkish. Anyway, here was the move down. Here was the move up through the moving averages. Here's the one where we come back down, set the low, nearly 60, just below, and then all the way back up to 70 there on the RSI. 1998, here we go. There's the move up. There's a slight pullback. I didn't really know where to draw this line. This one, again, coming out of a bear market, it's like it just doesn't wait for you sometimes. It just keeps going. 2018, I mean, again, here was your pullback. It really was 1 or 2 days, and then right back up again. RSI 60, pullback, then to 70. 2020, there was the move up. Here was your double top, your pullback right here. Move up to 60, pull back, then to 70. 2022, this is what we were looking at. There was your move up. Here was your pullback. There was your 60. Here's your pullback to 50, back up again on this move. And if we click on it, we'll get the latest. This is where we are now. So you can see how it's so far above the 20. Many of those just hesitate and then take off again. I'd kind of like to see this pull back to the 20, but it might not. We might not get that. Anyway, I wanted to just share all of that with you. Moving on. Now, this is the upcoming earnings relative strength chart list for this upcoming week. And if we put this in summary form and we sort it by the last 3 months, it tells you which stock relative to its group. So this is going to be relative strength of stocks, not their absolute strength. It's how they're performing relative to their peer group. Now, we could put the S&P 500 on here, but I want to know which stocks are leaders amongst their peers. And so in this morning's EB Digest, I put in here the top 20. I gave an image of the top 20. I think it went all the way down to LTH. So I gave you those top 20. And then if we go all the way to the bottom, I gave you those bottom 20 from BHC, I don't know, somewhere up. I think it was the ILMN. Just to show you that as they go into earnings, these were the top 20 and the worst 20 in terms of how they're performing relative to their peers. And then putting all of them into one chart list so you can see which ones are strong, which ones are not. This is, if we pull it up in edit form, 324 companies, lots less than last week. I think there's probably double that we had in the chart list last week, maybe more than double. The other thing when you're looking at this, it's numbered. The numbers here have a significance. 808 is August 8th. And then it's in market cap order. So the lowest number, 808000, Dominion Resources, that's the largest market cap company that reported this morning. 808001 is the next BNTech or BioNTech. BNTX, that's the second largest market cap, and so forth down the line until you get to the afternoon. So these were all right. So those would have been morning. Those were just, they're all that come out on Monday in market cap order. Then you go to 809, which is Tuesday, and they start over again in market cap order. So when you're in the edit, when you're looking at this in edit form, you can see which ones are the higher market cap. And if you see a low number, something, you know that those are going to be among the largest market cap stocks those days. So we put a lot of time into getting these organized the way that we want them. And then again, now that the market just opened here a couple minutes ago. So if I pull this up now in summary form, and we just do a 1 day, you can see which ones are having really good days, at least to start. So you can see Coinbase up 6%, Upstart 9%. Let's see in the bottom what's not doing well. Palantir, PLTR, I can tell you that one's not a very good looking chart. BNTX, one we were just looking at, off to a rough start, down 8%. AVLR, software, down 4%, so getting off to a rough start. RBLX, this is interesting because, and I'm just going to move right on into the 3 you must see, but RBLX is one that's interesting because I thought this one would probably have good numbers, and maybe it did have good numbers, but it's not off to a great start. We'll take a look at that as one of the 3 you must see. Well, it gapped down. It's already starting to rally back. Look at all these hollow candles. And if I pull this up on a relative chart, first of all, you can see the AD line. That means that you tend to close much better than you start the day. And we're already seeing a little bit of that, although it's very, very early. We could see a tremendous amount of whipsaw in the first 30 to 90 minutes. That's normally when I like to call it amateur hour. I think it goes until about 11 o'clock in the morning, but especially the first half hour, 9:30 to 10. I hardly will ever buy a stock unless it's benefiting me. I want to get in long and the stock's getting hit to the downside. But I don't, if a stock's getting hit to the downside, I really try not to sell a stock into that. A lot of times that's just a really fast head fake, and you sell, you panic, and then next thing you know, stock's right back up to highs later in the day. So you got to be a little careful with that. But look at the relative strength versus the broadcasting and entertainment. Last 3 months, we've been going up. It's been showing some pretty nice relative strength. So if this stock came out and reported better than expected revenues and earnings, I would be looking for weakness in the morning to take advantage. That's the way I would be trading it. Now, let's see, another one, PLTR. So PLTR, I believe, looked the opposite. I think this one looked horrible going into earnings. Now you look, it's bouncing, but let me see that. Yeah, see the relative strength versus software. it's been going down and maybe's come up a little bit off this bottom, but it's still really not strong at all from long-term perspective. I mean, even the last 3 months, I would say it's more flat than it is really that strong. So I'm not surprised by this at all, the fact that it's weakened here. And then let's look at one more. Let's go back to the top, pick one of those. Let's look at, I think I've looked at Coinbase recently. Let's look at Upstart. So yeah, Upstart's probably one I'd be careful with, only because the AD line has not been going to new highs. We remain in this downtrend, had a huge gap down back in May, rallied, made it look like that might be an exhaustion type gap. But then we went down and actually went a little bit below. So that kind of negates that. Volume, there's another gap down on big volume. Now we're just testing the 50-day. I don't know. I'd be careful. If we break through the 50-day and then we come back down later in the day and go beneath it, if you were really aggressive, you could short. I wouldn't short. I don't like shorting. Once my mentality is that we're back into a secular bull market advance, shorting goes out the window. I don't want to think about shorting anymore. I'm looking for long positions. I think that's where the money's to be made. Not trying, if the market's going up, a lot more stocks are going to go up than down. So your pool of potential shorts is dwindling. And then if the market overall is going up, it's just going to make it harder to win with shorts. I'm going to be with the trend, which I think is to the upside. So anyway, but look at the relative strength. Look at Upstart. I mean, this has just been horrible. I would not have expected this kind of reaction. I wouldn't have expected a good report. So if it's a bad report, it could be sell on rumor, buy on the news, in which case, again, I would expect maybe that we go back down again in time, but we'll see what it's doing on a 10-minute chart. Yeah, it's still up pretty good. Anyway, let's go take a look at the market, see if the market's holding on to those early pre-market gains, which I'm sure it is. Yep, Dow up 160, S&P up 23, NASDAQ up 100. Last thing I will show you here on the S&P 500 is the hourly chart. This is one thing that I've been watching. So we've set another high with another lower PPO. I'm worried that in the short term, we might just have a little bit of weakness just because of the negative divergences. And also, if you look at the daily chart, this 41.76 high today, this high over here was 41.76. See that? The close, 41.76.82. Today's high, 41.76.22. So we've got this overhead resistance. If we break above it, that would be so bullish on a closing basis. But the hourly saying negative divergence, maybe we come back down here just below 4,100. A stretch would be getting back down to 4,000. I don't know if we go back down there. We got the 20-day at 4,034, possibly a 20-day test. But that's about all I would look for to the downside. I've said before, I'm telling members, if we get a 20-day test, I'm most likely going to be back into the leveraged ETF that tracks the NASDAQ 100, the QLD. I just feel like that's what I don't like to do the leveraged ETFs often, but if I know that my risk is limited and I'm hitting an area where I believe we're going to bounce, that's where I like to play something, a leveraged ETF, because you only want to be in those while they're trending. Like here, off of this 20-day, you want to be in something like the QLD because it'll go up more than 2-to-1 because of compounding of interest. It'll actually go up. If you look at whatever the move is over these 3 days and multiply it times 2 on a percentage basis, QLD normally will go up more than that. But as it starts to consolidate and churn, juiced ETFs or leveraged ETFs tend to lose value. So you got to be careful. Anyway, I know we're way over today. I really apologize. Just wanted to get through those things. Listen, everybody have a great day. This is going to be another interesting week. Do we get that breakout on the S&P 500? What happens Wednesday and Thursday with those inflation reports? Those are probably the two big stories for me as we head into this week. Have a great week, everybody. Happy trading. Hey, and by the way, don't forget tonight, 4:30, make sure you're signed up for the EB Digest and come join us for this top 10 stock pick, sneak preview. Love to have you. Have a great day, everybody. Happy trading.